You mean to say that the 2012 report predicted a 2020 correction?
Yes, it is published report. The 2020 we said bubble will burst.
So you were prepared for the bubble to burst in 2020.
Yes. Quant is known for his research capability. We have set up Quant Global Research for a while. Quant means we quantify everything. How well you can connect the dots. In your kindergarten days, you have a drawing book and you have picture on that. You connect the dots and picture emerges. As you grow towards lower kg or upper kg, then you see that picture become bigger and bigger. This is exactly what we do.
Do you think that this predictive analytics can be stretched even into the future?
So it's not something which we built in last 2 years. We have 30 years of our own track record of predicting extreme inflection point, whether you talk about COVID, whether you talk about Lehman crisis. Right from 2012, in our books also in a strategy note, we have written about how from end 2019 until 2032-33, how the geopolitical volatility will move up. We'll talk about biological war, cyber war. We talked about highest ever wheat prices. We talked about highest ever crude prices. All these drama we saw 1 year back. We have seen a small trailer of that picture. Big ugly picture is still pending much later.
How ugly is it?
Just wait for the next book. We have tried to talk about in our next book.
Welcome to you, sir, on this brand new avatar of podcast. We'd like to know a little bit from you about the Quant mutual fund journey so far.
So Santosh, frankly speaking, this journey has been relatively new. But Quant is known for his research capability. We have set up Quant Global Research for a while, okay? But as you know, in India, nobody pays for research. So you have to build businesses around that.
Correct.
Earlier, we was doing research and servicing to the institutional client on the broking side, wealth side, investment banking, advisory, multiple roles, okay? So everything was revolving on that. But over a period of time, I realized that, whatever work we are doing in terms of predictive analytic thesis or some of the behavior thesis which talk about, people were not 100% convinced. So partly they used to follow, partly they don't used to follow. So we thought of, instead of servicing others, why don't we set up our own asset management company and we service to the masses in general. And that was the thought process of acquiring Escorts Mutual Fund in 2018. And since then, we are offering these products and we have been relatively more successful in this space.
So coming to that point we just made that you have research-backed fund house, does quant actually mean quantitative or is there something more to the name that most people miss out?
Okay, so actually, an interesting fact I just want to, because quant means we quantify everything, not about just quantitative techniques alone. Yes, as a house, we combine qualitative, quantitative, and behavior. So, as a combination, we do it. We call it fundamental Atma, liquidity, the prana, and sentiment, the Maya. That's our core belief which revolves around these theses. But predominantly, we are a behavior house. We try to quantify the fear and greed, the intensity of fear and greed, whether it's risk on, risk off, risk appetite. We try to capture these multiple data points. When you talk about quant means we quantify, whether you talk about earth analytics, whether you talk about liquidity analytics, you talk about perception analytics, or you talk about anything related to sentiments, we try to capture. And that's the way the word quant comes from background. We quantify everything which affects markets.
You just explained this bit of analytics. Your firm talks so much about predictive analytics, and there's also this famous VLRT framework that you regularly keep explaining to people. Can you take us through how this VLRT framework came about as a overall umbrella with your predictive analytics? Because this is something that maybe many people don't get, that the concept of predictive analytics, and you've arrived at a VLRT framework under that. So can you make it simple for us?
Okay. So predictive analytics is like a larger picture, If you really talk about in the industry, we have seen people do post-mortem analysis. Let's say earnings seasons are disclosed or results are disclosed. You have earnings call with the management, and then people take a call whether they have to upgrade or downgrade, and accordingly people react. Or some people preempt. They expect result will be good, whether it's a rumor which is floating around, or they have a perspective about it, or some people take a contra call. Okay, we don't do any of these things. So we have built a concept of predictive analytics. Idea is that how well you can connect the dots. Okay, so when we run our own complex multivariance model, both dependent variable put together, we try to connect the dot. Like if you, simple example I'll give you. In your kindergarten days, you have a drawing book and you have picture on that. You connect the dots, some picture emerges. If you recollect, as you grow towards lower kg or upper kg, then you see that picture become bigger and bigger. As you move to let's say first standard, second standard, you start playing with puzzles. Okay, this is exactly what we do. Okay, we try to connect the dot of multiple variants, which is data which is available to us, and try to see whether the picture emerging out of these connecting the dot becomes more and more clear. If picture is more and more clear, we have a more assertive view, or a clarity of thought is there, we take aggressive calls. When picture becomes blurred, nothing is visible, which means there is no clarity in terms of whatever analytics we are doing, we lie low. So that's a way. So in pure risk on environment, we are very aggressive house. In risk of environment, we sit on backseat. So in risk on period, we generate extra alpha and keep it for difficult time, and in difficult time we lie low. So that's the way we take this call. A lot of people consider that we do take a contra call sort of thing. It looks like a contra call, but it's not. Actually, it's a data driven call. So we are analytic firm, and predictive analytic is a thesis which we have built. VLRT is a product which has been derived from this predictive analytic thesis. Okay, like a lot of people talk about certain models they have built, certain theses they have built, and this is they share the logic. So very interesting aspect is that VLRT has been built from mistakes.
Hmm.
It's not something we have arrived in life and we created something very unique. In last 33 years, I have personally made a lot of mistakes. The team has
Any
mistakes.
mistake that you can point out that helped you refine this model?
The biggest mistake is that price is the biggest myth. Okay, as long price is rising, see, price, people say price bhagwan hai. Okay, that is a very not the correct way of looking at it. It is actually a narrative. Price gives you a narrative, and markets are driven in short term by narratives, but in long term, when you really reality is very different. So when you get carried away with the prices are riling, and every analyst is justifying the up move. Okay, and that's the way the problems start. The exit becomes a problem area. Okay, like I'll always say, buying is art and selling is data science.
Hmm.
So buying is very easy. A lot of people are very successful in spotting some opportunity through behavior data, through your observation about certain product or launches. But selling is becomes an emotional challenge.
Hmm.
Okay, when you made so much money in that stock, you think everything is right. Things have just changed for this company, and then now best of the analysts will give you 5 year, 10 years upgrades on that, and that's a time we look at those as inflection points. When we identify, let's say, stock sector or stock trading in the neglected territory. Okay, purely from a behavior perspective, we have defined like two bands: neglected zone and the most admired zone. So when you hit the most admired zone, we try to prune down our exposure, and when you hit the most neglected zone, or what you call it most hated territory, that's a time we are trying to build a very large exposure. The idea is that if you're buying anything in a neglected zone, your downside is anyway protected,
Hmm.
upside is open.
Ex-
And exactly same thing is there at the peak of the cycle. You may not get exact peak, but stock hit the most admired territory, and if you exit and look for a better opportunity, there's a possibility that you may not have sold. Stock will still rally further. But what is more important on relative basis? So absolute is important, relative is equally important. Relative basis, some other opportunity is there, and those stocks are trading in neglected territory. So we don't believe in that capturing the exact top or capturing the exact bottom, and that is the way it makes a lot of difference. Exact peak nobody gets, exact bottom nobody gets.
But still, over the last 1, 3, and 5 years, maybe this predictive analytics or VLRT framework has helped you stay on the top of the game.
Yeah.
Now, do you think that this predictive analytics that you are employing to be able to identify securities into the portfolio can be stretched even into the future? Because one thing is to have a great run, another thing is to have a consistent long term run, because most mutual fund investors are looking for that consistency.
So let me answer this way. Like most of the investors have seen our from 2018 onwards our journey. So let's say last 5 years or 6 years journey they have seen, which has been very good. But what is important? To 33 years I am doing this.
Hmm.
Okay, as a house we are doing this well. So it's not something which we build in last 2 years. We have 30 years our own track record of predicting extreme inflection point. Whether you talk about COVID, whether you talk about Lehman crisis,
So
whether you talk
let me
about
just stop you there.
yeah.
How was the entire COVID scenario for you and the fund house? How did you play that? Because we know post COVID you were one of those top in the recovery buckets, and you really hit it outside the park when your small cap and mid cap fund generated a staggering return. Now you seem to have got that COVID wave from
Hmm.
a market perspective really earlier on and did well over there. How did that come up in your framework?
So it's a interesting question. I'll also answer it. Has some background. Let's understand what was the background pre-COVID, how was the positioning of the portfolio, and the post-COVID the positioning. Okay, now right from, let's talk example of predictive analytics. Right from 2012, we have been showcasing, in our books also, in a strategy note we have written about, in our being relevant book, we have showcased the J curve, where we have tried to showcase how from end 2019 until 2032-33 how the geopolitical volatility will move up.
Hmm.
Okay, so entire forecast on the predictive analytic was revolving around geopolitical volatility, and in that period we have talked about how it was written in 2012. So how 2012 onwards, year by year, we have talked about what event can has potential to unfold. So in 2020, we have talked about bubble will burst globally, which happened in March 2020. In
Hmm.
this period, which I said end 19 till 33, we have talked about how we'll go through a very difficult phase. We call it wealth destruction phase.
You mean to say that the 2012 report predicted a 2020 correction?
Yes, it is published
It's
report. Okay,
interesting.
2020, we said bubble will burst. So that title was bubble
So
will
you were
burst.
prepared for the bubble to burst in
Yes.
2020.
Okay. Now it's very interesting thing. We talked about how 2020 till 2032. We'll talk about biological war, cyber war. Okay. We talked about economic war. We talked about highest ever wheat prices, potentially highest ever interest rates, particularly in developed market, including
Hmm.
US. Okay. We talked about highest ever crude prices, but not highest ever gold prices at that
Hmm.
point in time. Okay. All this drama we saw 1 year back. We have seen a small trailer of that picture. Big ugly picture is still pending much later. Okay.
How ugly is it?
That's just wait for the next book. We have tried to
So
talk about
so
in our next book.
so all these many people are seeing right now.
Yeah.
Now the new kid on the block is now AI, and you've seen how things have changed dramatically since the last few months. AI is, and stocks related to AI are just flying off. Is there anything that AI fits into your predictive analytics?
So if you really look at the when 33 years back when we started predictive analytic as a thesis, which we build it, okay, and there were no concept like AI or ML in our life. But if you really sit down and analyze, predictive analytics is actually a backbone of any AI.
Hmm.
Okay, so we have been doing it for a while. We don't call it AI. We call it predictive analytics. Okay, because there was no such terminology like that at
Hmm.
that point in time. But the thought process was something similar.
Hmm.
How well you can predict
Hmm.
by seeing the data, or by, so like we proudly say we are analytic firm.
Hmm.
Business is money management as a business is byproduct.
Hmm.
So if you are able to connect the dots and try to see, this is what AI is also all about,
Hmm.
trying to process thousands of data points, try to look at the past, which we do in more of a cycle studies.
Hmm.
Okay, so we have a lot of data. So I'll give you a small example. We have data like thousands years of wheat history,
Hmm.
650 years of corn history,
Hmm.
300 years of cotton history,
Hmm.
200 years of yield history globally. I'm talking about not India, because India, when people talk about backtesting, what data we have? Hardly 20 years data.
Hmm.
20 years data, you don't get even one cycle right.
Hmm.
So when we go back and look at 100 years to 500 years, 1000 year cycle, then you get some answers. And that's the part of our analytics. We call it cycle analytics, which we have built. And again, it's an evolving thing. It's not very simple. It's still very complex. Sometimes we are also lost.
Hmm.
Okay, and you have to really spend time. Why we talked about 2020? So it's a very interesting aspect because multiple cycles were culminating in that year.
Hmm.
Okay, and that's the reason, because we were trying to understand, like from 2020 we talked about how agri prices will go to the roof.
Hmm.
Okay, so we are trying to understand what will lead to, and I'm talking about 2012, what will lead to that. So obviously if agri prices will go up, it means something goes wrong with the weather condition or climate changes. So we actually worked on weather condition and climate changes. Then we tried to learn. So 9 years I myself had done research, my team has worked on it. Then we spotted something unique phenomena, how magnetic fields affects economy,
Hmm.
how it has an impact. So we have talked about how Russia will reemerge. In 2019, I have written how Russia reemerges in this period. Till this phase, Russia reemerges till 2028. So Russia cycle is very unique because we talked about how North Pole, which is in Canada, which we thought is actually shifted to Siberia in 2020. So
Hmm.
that was the important event which we talked about. This was a very important event which we talked about. Russia reemerges, and we talk about bubble bursting. So we have linked with the energies, how the energy changes. So some thought process we evolved over a period of time. So very, again, we don't claim we have a PhD in this work, But what is very important, we try to analyze from a market perspective. Our focus is how it affects market. Like it's been today, if you look at any global leader or national leader or businessman, will talk about weather conditions, climate changes. It's been fashion to talk about, but nobody quantifies. Okay.
Clearly, we're talking about so many broad subjects
Yeah.
as far as the outperformance or the performance of Quant mutual fund is concerned, and it's so broad a spectrum that you're using, from weather patterns to the price of agriculture produce and so on and so forth. So it's an interesting mix, because usually when you talk about the markets and we talk about performance, is usually related to maybe the earnings cycle, or maybe it's related to why a company did well or not. But here you've got a different look and different perspective,
Yeah.
and it's really interesting, because for most people it's only the stock price that all that matters for the performance of the fund. But here there's so much going into it. How do you keep at it on a daily basis? Because one thing is to have historical data, but you also have to make day-to-day decisions in a market which is also very exciting and very volatile. How does this huge amount of data help you?
So, what is very important to understand? Let's say, example, when we through Earth analytics, we can quantify or foresee a decadal view.
Huh.
Few decades perspective can be built. So, when we talked about the 2020 onward, this change will happen. As we came closer to 2020, right from September 2019, much before COVID, we are moving towards pharma sector, specialty chemicals, healthcare, IT, FMCG. Okay, the whole idea was that if something goes wrong, which was our forecast, which played out very well. Okay, we were trying to prune down leverage economy stocks.
Hmm.
Okay, so all banking, metals, cement, commodities, all these things. By 31st March, our exposure in banking was zilch.
Hmm.
We pruned down everything, but we have increased our exposure towards what I call mutual fund, insurance heavily in those days. Okay, so some data point which was showcasing this through Earth Analytics, but as we come closer to December 2019, we spotted through perception analytics that banking cycle has peaked out. Like how every analyst forecast on earning cycles. What could be the drawback of that is that it's based on certain assumptions.
Hmm.
When assumption goes haywire, you have positive or negative surprises. So industry work on forecasting on the next 5 years earning, 3 years earning. We spend time and energy to forecast earnings multiple through
Hmm.
perception analytics. So earnings are important, but perception is equally important. What multiple will give? Nobody forecasts multiple.
Hmm.
Okay, it becomes a balancing number.
Hmm.
When you want to do a upgrade or downgrade, you use this multiple as a balancing number, and you can revise or downward target. I have been analyst myself. That's the way, unfortunately, it's been justified in numbers. You can just change the multiple and everything changes. So it's for them, it's a balancing number. For us, this is the most important element of our perception analytics. That with the help of perception analytics, we can quantify the inflection points of a sector or a stock. Let's say in January 2020, we through a perception analytic, we spotted the banking perception has peaked out.
Hmm.
Okay, now a lot of people get into this thing, what is the value? Okay, so I always give you answer. Absolute data is important, but relative data is more important. Okay, because absolute can be as absurd or as bizarre as it can be, because you can't quantify what is absolute. Okay, so, but when you look at data on relative basis, even returns are relative, you give much better perspective.
Hmm.
So, on relative basis, you said that this is the best cycle we have seen. It has peaked out, now started drifting down, and that's the way we quantify. So that there's a time that banking has to be moved out, leverage economy as a concept has to be removed from your portfolio, and we did it. So we were so background through Earth Analytics, the data was visible.
Hmm.
So we also do something on the what we call it volatility analytics, how we can forecast the volatility.
Hmm.
So that help us from a longer term. If I have to look at for next 5 year cycles, 7 year cycles, we can do through volatility forecast. And we talked about how 2018 till 2023, the employed was so the global asset class will remain elevated.
Hmm.
And something similar when we started Quant in 2007-8, we have actually predicted that in during the Lehman, much before the Lehman, we have said that volatility will spike. Okay, and it spiked. Actually, those days used to run a very large prop money, and we made tons of money in that month. So in the Lehman crisis, when people have lost big money, As a house, we generated massive alpha.
Hmm.
Okay, we actually generated 18 crores prop money that year,
Hmm.
and that was the genesis of building multiple other business at that point of time. So forecasting volatility is a very important subject for us, and it's like a behavior data point. Okay, and that really help us. Again, nothing should be looked in isolation. So we talked about this price. The problem with the price is that because any valuation analytics you look at, everything is largely dependent on price.
Hmm.
Price changes, you need the free cash flow data or few other parameters. Most of the analytics or the multiple data is actually price linked. When price changes, everything changes. So you actually become slave of data,
Hmm.
of price. That's the reason you talk about analysts upgrades the down most of the time on the price behavior.
Hmm.
Okay, what we uniquely try to do is that how to remove this bias. See, criticizing this failure is very important. That valuation analytics has this fail,
Hmm.
this drawback. But how to address this problem? So what we do very interesting in our VLRT framework is that we bring two-third weightage. We have given weightage to the macro data,
Hmm.
like liquidity analytics, risk appetite. These are macro. So instead of 100% weightage when industry looks at the valuation analytics, we give two-third weightage to the macro data and one-third to the valuation analytics.
Hmm.
And within one-third also, we tried to see how if I can bring down the dependence of this dependent variable price below 10%. Then I'm able to judge better.
Hmm.
My biases goes away. So if I'm able to remove from 90% of biases to below 10%, then we are not attached with any stock. The prices don't disturb us. You will able to take much better realistic call rather than getting carried away with particular price movement.
There's really far too much amount of finer data that goes into
Yeah.
building a mutual fund portfolio, but whereas most of us are so happy with just the selection of a fund and hoping that we make good returns. But I think, thank you so much for taking time
Hmm.
to explain these nitty-gritties to how a portfolio construction happens. We'd love to chat more with you, but then I want to keep time in mind. I have 2 3 questions,
Yeah.
and I'll break this down in this way. I'd like to hear from you how you see the next decade from now. And while we're looking at the longer picture of a decade from now, the next 1 year from now, I think the world will be in a lot more different position 10 years from now,
Hmm.
but in a little more predictable fashion, maybe a year from now. More interestingly, today we are on the 25th of May. In less than about 10 days or 12 days, we will have the election results out. And in a month's time, we'll even maybe have a, build up for a new budget. How do you see this extremely short term between about a month from now and a year from now and 10 years from now? It'd be interesting to know because there's so much data that you just explained to us about. How do you see all these things?
Okay, so let's address the longer term view, or decadal view. Okay, so based on perception analytic, we have say India perception is actually quite good. In my 33 years of my career, I have never seen such phenomenal macro. So
Okay.
on absolute basis, they are great, but on relative basis, they are extraordinary.
Huh.
Relative to US, relative to developed market, relative to China, we are in a very unique situation. If your perception is changing or rising, you will attract good amount of liquidity towards this country.
Hmm.
Okay, and I always say that this decade belongs to India, maybe half century belongs to India, and within that we also talk about that Asia centric emerging market will attract more flows
Hmm.
from developed market. And you see this phenomena will gather momentum more from mid 2025 or end 2025. You will see, if whatever reason US start correcting,
Hmm.
okay, or start consolidating, if opportunity in today in US is very meaningful. That's the reason when money shift, if 10% of money shift from US to a country like us, there will tsunami out here.
Hmm.
Okay, so that's the way we look at the liquidity analytics and perception. When you combine the liquidity analytics and perception aspect,
Hmm.
then leads to a money flow analytics.
Hmm.
How money gets shifted from one asset class other, one stock to other, one region or country or asset class. This is something which we uniquely look at, and this is where we can capture that India is in a very unique situation. So from investors point of view, we always say India remain buy on dip strategy. Okay, never exit this market. Something has changed in India and is changing with a different pace.
Hmm.
Don't look what happened in 2000, what happened in 2018. It peaked out. It has not worked, and it will not work going forward also. Second thing, coming back to the, if you have to look at, let's say, from an event specific point of view. Now, as a macro house, let's this year some 45 countries are going to election.
Hmm.
When we look at data, every quarter one or two countries have election globally.
Hmm.
Okay, so for us it's a one of the events.
Hmm.
It's not the event which we are looking for it, and sometimes that hype becomes much larger.
Hmm.
Okay, because of like every closer to the budget, every newspaper channel will talk about budget, this happening. But if you really look at India, and budget has become irrelevant thing, the relevance of budget which was there earlier, it's lost. Similarly, given the background, I think it's an event which is playing out more from a narrative perspective. But the way we have designed our portfolio, let's say last few months we have increased liquidity in our portfolio.
Hmm.
We have also moved towards marginally towards safety. We have pruned down high beta names. We are playing it safe. So as long this event is there, let's say nobody can predict with certainty this is going to happen. Okay,
Hmm.
if something goes wrong, okay, in terms of whatever the narrative which is built right now, at least you should be protected. So neither I'm too complacent nor I'm too worried. Let's look at one more data point. But again, I was talking about absolute and relative. So, on absolute basis, yes, people might say that BJP can come down or NDA can come down, or because they have a very large base of 2019. Okay, so it's very natural that if you have already achieved in certain stake, you have like majority of the seats, 100% seats you have win, so you can't cross those numbers. So the best case scenario you have already achieved in 2019.
Yeah.
Okay, and don't compare what happened during Rajiv Gandhi fate. That was a very different emotional thing issue was there. That's the reason you got that 4 not 414 sort of seats. I think that phenomena is not going to get repeated so easily ever. That was the one specific event. Now if you look at absolute basis, let's say if you are saying yes, it can come down, maybe answer is yes. But now you look at relative, what is the alternative of Mr. Modi? There is no concrete alternative. So when you go out and vote and you stand in the ballot vote, what is the option you have? If you have any concrete option, you can say. So that's the reason, again, we are not attaching with any party. What we are trying to say, absolute, relative, both are important. So on absolute basis you can say come down, but relative basis there's nobody else.
Hmm.
And hence the probability, see, we are student of theory of probability. We keep on identifying winning traits and keep on managing risk on a consistent basis or regular basis. You will generate alpha. That's what we do. So we don't get too much upset or worried about a event. Yes, because of event, whatever precaution we have to take in our portfolio, we have already done. We are not buying protection. We are not too nervous about it. We have made minor changes in our portfolio which will manage this event. Okay, and let's events come out to a blowout rally, we might underperform for few days. We are okay with that part. So
Hmm.
massive outperformance we have given for few days or few weeks, underperform doesn't. For us, safety is very important. The
Hmm.
entire focus of Quant Mutual Fund is about risk management. We very proudly say we are in the business of risk management. Returns are byproduct.
That's an interesting part because most people associate quant with outsized returns. You're talking about risk management. Before we let you go, just one last question. You give us this very great, long-term picture of India attracting a large part of global capital. But if you notice in the last 24 months in particular, bulk of the global falls are actually going away from India. So you see that reversing anytime soon?
Again, I'll answer that. So again, absolute and relative. On immediate basis, a relative opportunity in China or some other emerging market looks better. India has been outlier. India has performed very well. If some portion of money moves out from very short term perspective to other countries, because you have to look at a foreign investor has options. For us, as an Indian, we this is the only market we invest, but they have option to invest in, let's say, 18-20 countries globally at any given time. So they will look at their absolute return. What they're more interested in the relative returns.
So you see it's going to, at
It's
some
a
level,
more of a
change.
relative thing. But let's
Okay.
say down the line, few months, I expect that maybe next few months, China cycle also peaks out.
Okay.
Yes, China has bottomed out, so the relative opportunity was better in China. So if I was in their place, I will also done the same thing.
Hmm.
But China is no more a structural story.
Hmm.
India is a structure story. Even money will move out from a very, let's say, from a very medium term perspective, but from a long term perspective, will come back. And then let's say if this government comes back, a lot of FIs will look at again clarity for 5 years.
Correct.
The money can come back. There could be a tsunami also, as I'm saying. Maybe if not immediate basis, maybe down the line with a few quarters slack, it can happen. When China, from a very near term perspective, peaks out, emerging also market becomes slightly expensive. India is a structure bull run. In the structured bull run, money will, and we have a size. Like it's not like Vietnam or Philippines; they're also doing well, but their economy size of economy is too tiny.
Yeah.
Okay, if money has to shift from developed market, particularly Europe and US, India is in a unique situation. We can absorb that capital. Okay, can Vietnam absorb this capital? Answer is no. India can absorb. So very important that whether market has potential to absorb this much liquidity.
Hmm.
Okay, India has potential to absorb, and that's the reason money will shift with a lag effect.
In a a structurally good looking and bullish economy like India, even now, almost on a daily basis, we get asked this question: how or what time do I enter the market? So which means timing is still a important factor. How do you treat this whole concept of timing the market?
Okay. So Santosh, from a timing is a not a trading tool sort of thing. A lot of people say nobody can time the market. Time in the market is important. Yes, I
Yes.
agree. Time in the market is more from experience, but timing is everything.
Hmm.
As a management student, we have been taught timing is everything else, and everything else is conjecture. That's the way we define it. Okay, but very important to understand timing is a risk mitigation tool for us. Okay, timing is an analytical tool. Okay, let's example timing analytic is a function of our VLRT frame, is a function of valuation analytics, is a function of risk appetite analytics, is a function of valuation analytics. So the combination is that. Let's like give you a small example. When COVID happened, okay, what happened during the COVID time? The risk appetite collapsed.
Hmm.
It was multi-decades low in March 2020, and liquidity, because Curtis Central Bank, they're working tandem, liquidity was lifetime high. It's
Hmm.
higher than the Lehman crisis. So that's a perfect lethal combination. When your risk appetite from extreme bottom is inching up and liquidity is higher, this is a perfect background, a perfect timing for a massive bull run.
Hmm.
Okay, so that's the way timing parts comes into picture. When you combine all three analytics, then it gives you, it's like when multiple data points are skewed on one side, better timing.
Hmm.
And timing is everything, because actually timing reduces the risk. If you have not sold your portfolio in September 2021 for IT,
Hmm.
you have missed, which we
Correct.
sold. So we said timing is very vital. And something similar, let's say consumption themes people are talking about, we launch a product around that on the January. We said the early signs of consumption cycle bottoming out,
Hmm.
real rural economy, because we subscribe a lot of data through high frequency data. We talked about this, something is coming. We are early in identifying a inflection point. So
Hmm.
timing is the inflection point tool for us. On the extreme inflection point, we are seller. On extreme inflection points, are we are buyer. So that is all
So
about
it's
timing.
a very interesting now perspective that you've given on timing and with the COVID example. So now, how are we on that timing basis? So you give us this high frequency data, and how COVID was a great example where you had decadal lows in the valuation, but a very high liquidity framework. How are we placed right now? And are we, if I enter now, am I timing it right or am I timing it wrong?
So I say it's a very vital question in today's context. So let me give you perspective. If I have to give you a summary of what we are looking at from a timing perspective, we believe that easy phase of bull run is over in India also. And
Okay.
I'm using the word easy phase. We are in decisive bull run. And within decisive bull run, we are in difficult phase of bull run. Okay. So it should be very clearly understood, we are still in bull run, but we are in difficult phase, which means anything you buy will not give you returns.
Hmm.
Okay. And hence, from a risk mitigation perspective, your sector rotation, stock rotation will play a very important role. Okay. Now, if you look at the duration point of view, when you also talk about here, you cannot buy for 10 years, 5 years perspective, because that phase is over.
Hmm.
Now you have to manage your medium term and short term duration product also very well. Those calls becomes very important, because you generate, see, it's a very important myth in the market when people say I'm a long term. When it comes to mutual fund, everything is long term. Yes, investors are long term, asset classes are long term, stocks and sectors are not long term. Okay, why everybody talks about long term? Because managing long term risk is very easy, and this
Hmm.
will give you, because a lazy way of doing it. When you manage your short term and medium term risk better, you don't only protect your downside, actually generate alpha out of it, and this is our key
So that
strength.
comes to a very interesting debate that's raging right now. That is the active versus the passive. Now you just said that we're in the decisive part of the bull run where not everything will run up. You have to be careful. Which means, is it now the inflection point for active management to do way better than index funds or just the passive funds that in the last couple of years, there are many passive funds which are done way better than even the actively managed funds. Are we at that tipping point?
Yes. So in the easy phase of a bull run, obviously passive will do very well, okay, because the cost structures are right. But in from today's context, in this decade, I have to look at right from September 2021. I'm saying that when you get into value as a thesis, so only the funds which has a value thesis, passive fund, might still do better. But in general, this is a time for active money managers. And also a very important thing I'll give address this. See, uh, active fund manager lost their relevance. It's not because of passive has come up. Okay, what happened post Lehman crisis, that people were generally worried. So everybody globally, I'm not talking about India, globally people started hugging towards the benchmark. Okay, just to play the safety game, because the liquidity, this sort of liquidity crisis, maybe we have not seen for many decades now. Okay, suddenly something new had hit us. The people were playing safe. What has actually happened? So active money managers are offering a quasi passive product, and investors are more smarter than the money managers. When they realize you're taking a fees of active money management, when you're offering a quasi passive product, they move towards passive product.
Interesting.
Okay, and the cycle was right. So right from August 2012 till September 2021, that was the growth at any price, and one way bull run was there. When that phase gets over, the generating alpha out of passive will be very, very challenging. And I think this decade belongs to active money manager like us, who will.
Clearly, that's a very interesting perspective for people who have this doubt in their mind on why I should even look at the active funds when passives are doing so well. I think that's something for our viewers to keep in mind. We hope to, catch you sometime soon. But thank you so much. I mean, we're so happy that we got to hear from you much more than just fund performance and the number of funds that you have. Today, we got to understand your analytics story, the story of how you make your decisions, and even your predictive analytics of how you got so much data going in. Thank you so much, sir, that you joined us this today, and you helped us understand in detail how your thought process is in terms of building, because there are many people who know that Quant is doing well and they want to know what was ticking you guys to do so well. And we are so glad that you took time today to explain this to us. And I hope for all our viewers that this is a great understanding that sometimes it's just not about putting a bunch of stocks in your portfolio. There's just a lot more. And today we just learned that there's so much more that goes in to building good portfolios. Thank you so much, and I hope to have you soon back. We want to know how we can play this whole decadal shift, and is there any emerging trends and sectors that we should look at. But then maybe we'll follow through on another podcast. Thank you so much.
Thanks, Santosh, for inviting us. Thanks.